So session 3 is going to be about the iron butterfly, a very close cousin to the iron condor. I will be making that comparison at the end. Before that, we'll spend some time putting the iron condor together in a similar fashion as we've done today. In session 1, we put together the combination by starting out with a few simple strategies, putting them together. We did that in session 2, and here again in session 3. So all told, we're getting through 9 strategies this morning. So there's a lot there, going from basic through intermediate to advanced. The iron butterfly is similar to the iron condor, and we'll put it together using 2 different strategies than we just did previously. 2 different strategies that have interesting risk-reward profiles attached to them. Our disclaimer: options are not suited for everyone. They are complex tools. It takes a deep understanding of the product if you're going to use them in a live account. And the strategies that we're going to go through today all involve multiple legs, multiple pieces. So please keep in mind commissions and transaction costs. They do apply and they will affect the risk profile of these trades. For the sake of simplicity, and this, considering the fact that everyone's commission is different, we do have commissions excluded from the numbers that we're going to put on the board today. About OIC. Founded in 1992 by the exchanges as an industry cooperative for the purpose of dispelling myths in the options industry and helping retail investors, money managers, financial advisors, institutional investors feel comfortable using the product. That's why we exist. There was a lot of myths and misunderstandings about options way back in the beginning years when we were founded and started trading listed options in 1973, and then we moved into the 80s and 90s. The industry wanted an entity like ours to exist to help people feel comfortable that you're going to get unbiased education about the benefits and the risks, and we're never going to sell you anything. I heard a question just a few minutes ago: how do these guys get paid? And where's the money come from? You guys don't charge for this stuff, and we don't. The Options Clearing Corporation, the OCC, is the backbone of this industry. They clear the trades, they manage the risk, they fund our efforts. The money comes from OCC. OCC's money comes from transaction costs. They fund our efforts. We work off a budget. That means we don't charge you for anything. These sessions we're doing today, free of charge. Our online sessions, free of charge. We do online webinars every single month throughout the year. We don't charge you for those, and our website has plenty of material. We just don't charge for anything. We're here as a resource to help people understand. The Investor Services Desk, make sure you take that email down, options@theocc.com. They will answer your options-related questions and help you out as best they can. They get to every question in just about 1 business day. They're a great resource to utilize. And again, it's at your service, so take advantage of it. I said we were going to go through different strategies to put the iron butterfly together than we did for the iron condor. That's exactly what we're going to do. We're going to start with the short straddle trade, move into the long strangle, and then put together the iron butterfly. See what that looks like, and then compare and contrast the iron butterfly to the iron condor. Straddle trades in general are regarded as the purest volatility trade. This is trading a call and a put option at the same expiration date, at the same strike price. You're either buying both or you're selling both of them. Generally speaking, these are at-the-money options. So whether you're buying or selling, this trade is all about how far might the market move in either direction. It's not biased up or down. It's how much might it move either way. That's all about volatility. In this case, we're looking at the short straddle, which means we're selling the call and the put. Same strike, same expiration date. Now, just giving you a little background about how a professional firm might be utilizing this strategy. For a brief period in my career, back at the beginning of my career in 2000, 2001, I was trading for a small hedge fund. And one of our portfolios was called volatility arbitrage. And this is all we did all day long, was analyze implied volatility levels in the market for dozens of different stock symbols. We had a small team of financial engineers that were extracting data from the exchanges, so they could look at volatility in previous years for that specific stock, I should say implied volatility in previous years, compare that to current levels of implied volatility, And if current levels were higher, that was a sell candidate. And if implied levels were lower, that was a buy candidate. It was our job to then vet and scrutinize those possible trades. And if we decided to go ahead and execute those, it was straddles. Calling the exchange floor and selling it at the money straddle, or calling the exchange floor and buying it at the money straddle. We were trying to be neutral on both sides, have just as many shorts as we did longs to keep our exposure neutralized. That was the entire strategy, looking for the current level of implied volatility to gravitate towards a long-term average. Who's familiar with historic volatility, what that is? Historic volatility by itself is what the stock has done, stock price movements in the past. Implied volatility is what does the options market expect the stock to do, or what volatility level is the option market using to derive its current prices. Historic is looking back on the stock. Implied is looking ahead and is used to price the options. What we did as a strategy was mostly ignore historical volatility. We didn't care what the stock had done. We were analyzing current levels of implied volatility to historic levels of implied volatility and forming an opinion from there. Question?
Yeah, quick question. So in the prior two seminars that you guys have given, you've told us to pretty much kind of settle on expiration dates that are within 2 months. I'm just wondering with this one, because you've mentioned historic volatility, if you're suggesting longer expiration dates.
The question is about expiration dates in the short straddle, specifically the difference between using longer expiration dates consistent with maybe what the stock has done over a long period of time or what implied has done over a long period of time. The driving force behind this would be similar to any other credit strategy, which is capitalizing on decay. So you would treat this similar to other credit strategies, selling option strategies, in the sense that your comfort level on when do I like to sell options would be your starting point. If you do decide to go out longer because your market analytics is spanning a wider range, then you would just have to realize if I go further out in time, I'm going to get slower time decay. If I go out 6 months or 9 months, that decay is going to be rather slow. So you can do it, but the driving force or the starting point would still be consistent with any other credit strategy. When do I like to sell options? Is it 2 months, weekly, whatever it is? So how does a trading firm do this? We walked through that. We manage positions, we buy and sell according to what we thought future levels of implied volatility would do compared to what they were in the past. Is everyone sort of with me on that? You don't have to fully grasp that. That's different from what the retail investor is going to do. That type of analysis I just walked through, that's labor intensive. And we had 3 financial engineers working full time on the data. So that's not really what the retail investor is going to do here. Here it's much more specific on a situation where you think the stock has moved quite a bit and now it's not going to move so much. So you decide that implied volatility levels are rather high and you think they're going to drift lower, or the stock movements in the future are going to be a lot less than they just were. That would lead you to a short straddle position. One thing to note, which we will get to, is since we're selling a call and a put here, and we're not yet buying protection, of course this would have to be done in a margin account. And your risk to do this trade is quite high and would also likely require the highest level of trading approval. But here's our example. We're in the same expiration date, January, at the 85 strike price, selling a call and selling a put at that strike. What we're trying to do is take advantage of a neutral market or a declining volatility level. There's a whole host of things to consider here. We have a short put and a short call. Now those by themselves can be looked at differently. I'm going to repeat this later when I walk through the graphs, but I want to point out right away that we have risk to both sides. We've sold a call, we've sold a put. It's perfectly reasonable to view the risk on those sides very differently, just because of the risk associated with each. The short put obligates you to do what? To buy stock. You might be comfortable with that. You could think of that side of the trade as a cash secured put if you wanted to. The upside obligates you to what? Sell, short stock. Most of you, if not all of you, won't be taking short stock positions too often, if ever. So the upside could be much more concerning to you than the downside. And you might manage the risk on both sides of this just a little bit differently because of what the obligations are. The put side might not be as scary as the call side. If you are assigned on the put, you bought stock, maybe you're okay with that. Now you're long stock and you can do whatever you want with it. Hold it, buy a put for protection, sell a call and turn it into a covered call position, turn it into a combo. You can do all sorts of things with the long stock position and you might be okay with that. The call side, a little bit different. The call side is where that unlimited risk comes from. And of course, limited reward. Consistent with any other credit strategy we do, any other selling strategy, we can only make what we receive. The credit received is it. Short straddles tend to be rather expensive. That's why they're sold in the first place. We've talked today about trading before earnings announcements. This is when you might see a straddle trade for high premium amounts, right before an expected move. Buying the straddle can profit in both directions, but you, generally speaking, have to pay for that. Market makers and professionals don't give away that for free. So shorting a straddle is an attempt to capitalize on an expensive strategy where you can receive premium, but you are taking on quite a bit of risk to do so. Theta is your friend here. Theta is on your side. Mentioned it a few times today. The time frame at which you choose to sell your options could vary from one investor to the next. The curve of decay generally shows that 6-7 weeks out till expiration time frame is when that begins to accelerate, but it's up to you. You can go further out, as was suggested earlier. If your market analysis is looking at a wider, longer time frame, you can go longer than that. Or if you want quicker time decay, faster theta decay, you can go shorter than that. Risk of assignment, just covered that. Very different from the downside and upside. Risk of assignment on the put side, you get stock. You might be okay with that. Risk of assignment on the upside, the calls, is shorting stock. Very different. So managing the position on either side is something you have to be very aware of. Continuing on with our example here, stocks at 87.5. We have 45 days till expiration. We chose that to be consistent with the generally understood theta decay graph that I just walked through. We're selling a call and a put at both 87.5 strike prices. The total amount is $4. So how much can we make? $4, that's it. In exchange for that, we're giving up obligations on both sides. So we have a nice range of profitability here, which we will see in just a second. We've sold this for $4. Our maximum gain is $4. The maximum loss is? Unlimited. And that's on the call side. You could say that the risk is substantial to the downside, but bound by zero in the stock, and unlimited on the upside because the stock can go infinitely higher. There's no ceiling on how high a stock price can go. Now, I have had some people challenge this unlimited description of the short call, and I understand you can use stop losses, you can manage the position, you can do different things to try and get out and never have to deal with an unlimited loss, understood. But as it's constructed from an educational perspective, the loss of selling a call without protection is unlimited. I mentioned margin before just because you need to be aware of it. It's there. Margin varies from brokerage firm to brokerage firm. Each of them have different levels of risk tolerance that they're comfortable with, and they have teams that run margin analysis on all of their accounts, and it could be different. One firm is going to be more strict than the other. Generally speaking, the ones that are more strict with margin, the ones that will trade you out of positions more quickly, are generally the ones that are of lower commissions and less service. There's that balance between commissions, freedom, flexibility, and service that you get. So you have to decide what's best for you, but there will be something. And the example that we have here is from the exchange minimums. Break-even points. Well, we sold this spread for $4. Stock can go in either direction. If it moves lower, We have to ask ourselves, at what point do I give back the $4? The call will expire worthless if it moves lower. I'll be obligated to buy shares at the strike price, 87.5. If the stock's at 83.5, that means I'm $4 underwater on that stock position, or I gave back the $4 I received up front. Same analysis on the upside. Obligated to deliver shares at 91, or obligated to deliver shares at 87.5. If we're assigned on that call option, we receive $4 up front, so we give back the $4 up at 91.5, and that becomes our break-even points. Does that make sense? Short straddle. And here is the visualization. It's always nice to see this, and this is very easy to construct when you look at stock prices at expiration and what various levels of stock prices will attach themselves to various levels of profitability on the trade. To visualize this and see, okay, now that I see what it looks like, is it consistent with my market outlook? It's always a useful exercise to undertake. And a common question that I get is with respect to all of these P&L graphs that you see being at expiration. Well, what about before then? Frequently, trades are closed and never reach expiration. Most options trades never do. So that question comes up. Well, prior to expiration, you don't know what the time value is going to be. Nobody can tell you what implied volatility levels are going to be a week or 2 weeks or 3 weeks from now, or even an hour from now. They change all the time. So you don't really know what the time value is going to be in an option. At expiration, however, time is zero. There is no time value. So we can draw these clear, crisp graphs of profit and loss at various stock levels at expiration, knowing there's no time value, there's only intrinsic value. But what if you want to know? If the stock moves to 90, or if the stock moves to 86, and there's still 3 weeks left, what is this going to be worth? Well, you're not totally in the dark on that question. On our website, optionseducation.org, we do have an options calculator within our tools. And it's very useful, at the very least from an educational perspective, or more useful if you're trying to analyze a position, to enter in all of those details and calculate an estimated value for what the call and put might be worth. You can take your current trade, put in the stock price, the strike prices, the days till expiration that you're trying to forecast. You will have to put in an implied volatility level, and that's where things get fun, and then calculate call and put prices, see what they're at, and then move the implied volatility level. Move it up 5%, move it up 10, move it down 5, move it down 10, and see what the various levels of call and put prices will be theoretically at those levels. That's how you can estimate what a spread or what an option might be worth at some point in the future prior to expiration. So don't feel like you're in the dark knowing, I have no idea what's going to be worth 2 weeks to expiration. You can predict that somewhat, but you do have that great uncertainty with what's the implied volatility going to be. There's our short straddle. Now we want to look at a very closely related trade, which is the long strangle. Long strangle involves buying a call and buying a put, just like the long straddle would have. But in this case, we have the same underlying, same expiration date, but we're going to move out in strikes. Specifically, we're going to use out of the money strike prices, buying a call up on the upside and buying a put to the downside. You might already be able to figure out that the prices of the out of the money options are going to be less than the prices of the at the money options. And here's what that might look like. The long strangle, we have the Jan calls and the Jan puts, so same expiration date, reaching a little bit out of the money. Stock's at 87.5. We buy the 85 puts and we buy the 90 calls. And there is what our strangle will look like. The idea here is to take advantage of a big move. Already been asked about earnings announcements and trading things prior to earnings announcements. Well, here's another trade that would be consistent with a binary event like that, is the long strangle. You're expecting a big move. You can buy a straddle, that would be expensive, or you can buy a strangle that is less expensive. It's less expensive, but it also will require a bigger move in the stock in order to reach your strike prices because you're going out of the money. So you're trying to capitalize on a big move here. Rising implied vol levels will also help. But since we're long options, we're flipping the script from the short straddle, we have limited risk. That's the idea for this trade. You think a big move is coming. You want to spend some money that you're comfortable losing and take advantage of a big move. You just don't know which way it's going to go. So we're going to walk through, and I will read through our example here. Fortunately, we're not using stock XYZ here. So Gin has been following a pharmaceutical company, and it has its cancer treatment drug trial. When testing results are released, so this binary event, something is going to be released. Big news is happening on the stock. When that happens, Gin is expecting a big move in share price, possibly up, possibly down, but whatever it is, a big move is coming. Shares are currently 87.5. So now what's the trade? What do you do? Here is a possibility. Going slightly out of the money to the 85 put, slightly out of the money to the 90 call, and buying both of them. Now again, it's not as simple as just saying, hey, I think a big move is coming either way, so I'm just going to go ahead and buy these two options. And if it moves, I'm going to make money. You really do have to look at how much you're paying, right? Just like anything else you buy in life. You might want it, but what's the price? I have to look at that first. If you buy both of these options, you're paying $2.50. The stock could move in your favor, and you still might not capture all of that premium. You still might not profit, and that's one of the most frustrating parts about being long options. I will, from time to time, hear from investors. This is specifically prior to earnings. They may buy a call option thinking this stock is going to rally after the earnings announcement. And after the earnings, the stock is up 2, 2.5, 3, 3.5%, and they're down money. And then they call, saying, I'm getting ripped off and something's robbing me and this should be higher. I've got a better example for you without getting into too many specifics. Not too long ago, spoke to an investor. Stock was trading around 100. They were bearish. They went out a few months and bought an 80 strike put option, which was very, very expensive. That should be a tip-off. Very expensive 80 strike put option. Stock's up at 100. Stock crashes to the low 80s. And the put option went from $10 to $11. And he called. Who's ripping me off? Now, it was trading at $11. There were sellers at 11. So I said, look, the market is what it is. Market participants set the price. You're not getting robbed. Someone's selling these options at 11. That is the open market price. Don't call me. Call the guy selling them at 11 and say, hey, what are you doing? But you're not getting ripped off. What happened was he paid a very high premium amount for those 80 puts, and he needed a bigger move than he got. Believe it or not, that 18% move was not enough because so much premium was in those options. He needed a bigger move and just didn't quite understand that the option that he paid 10 for with that big move, it wasn't going to go from 10 up. Implied volatility, after an announcement, after big news comes out, implied volatility levels drop. Now, who's familiar with the volatility skew? Okay. Well, it could, yes. So there's two things. I'm gonna just briefly gloss over skew. I try and maybe throw some things out that maybe people don't quite understand, but it's okay. If you don't get it, you'll hear it 2, 3, 4, or 20 times, and you'll get it. So volatility skew is rather simple. Every strike price has its own implied volatility level. You could plot this on a graph. The at-the-money strike has an implied volatility level. The out-of-the-money calls have implied. Every strike has its own volatility level. Because downside protection is so prominent with options, the general normal skew that you have is when you plot these implied volatility levels, the low strike prices are very high. And then they start to drift down. And when you get to at the money, they're at the lowest level. Actually, when you're slightly above at the money, they're at their very lowest level. When the market's calm and just moving slightly higher, everything's good, you have lowest implied volatility level. So as you plot this curve and you connect the dots, you have very high implied volatility levels at the lowest strike prices, and then they come down in this curve-like structure. Well, think about, if you're following me on that, think about what happened with this example. The stock was at 100, and this investor bought the 80 put options. Far out of the money, far down the curve, very high implied volatility levels. When the stock dropped to 80, let's just say it went to 80, it's not out of the money anymore. It's now at the money. So you mentioned volatility crush, and volatility crush is correct because when you have binary events, the whole curve moves down. The whole curve moves down as a crush. But in addition to that, in the example I just gave you, not only did that happen, But his option went from an 20% out of the money put way up here on the curve to an at the money put way down here on the curve. So that's what I refer to as an option sliding down the curve, or sliding up the curve, depending on which way you're going, but sliding along the curve. When you're out of the money, vol levels are high. Does that make some sense? I mean, maybe not total, but in that case, not only did volatility move lower across the board, the whole curve moved down. In addition to that, his put option slid down the curve to an at-the-money strike, which further exaggerated the issue. So an 18% move lower yielded virtually nothing for the investor. But it was legit. It was what the market was showing, and it was trading right where it should have been. Rather than arguing with the market, learn from it and understand. Maybe if an option is 20% out of the money and it's still trading for $10 at a $100 stock, maybe I need to be concerned about why that is and what kind of move do I really need to be profitable. So that's just a little bit about skew and volatility levels. Back to our example with the long strangle. We have the 85 put and 90 call trading for 2.5. How much can we make? We own a call, we own a put. Well, it's unlimited. It really is. We can set targets for ourselves. We can try to determine if we want to make 100%, 200%. What do we want to make on this trade? But in theory, as it's constructed, unlimited. How much can we lose? $250. We paid $250 up front. The value of this spread cannot go any lower than 0, so we know exactly what we can lose, and that's $250. Now, when I see these numbers of 100%, it kind of reminds me of something. Who's seen videos or YouTubes or commercials from, I'll call them gurus, who say, I'm a genius, I know options by the back of my hand, you need to sign up for my service? I mean, who's seen these kinds of things? Not as many as I thought. Okay, that's good. And a lot of times those individuals are touting trades that they've done. And they'll give you specifics. Look at this trade I did last month and I made 400%. Look at that trade I did and I made 1,000%. And if you sign up for my services, you're going to be a millionaire. And of course, I need your monthly money because I'm so great at trading, I still need your $30 a month. Go figure that. But options can give you those kinds of returns. Long options can do that. However, you have to be right on direction and timing and magnitude. What you don't hear is how many times did they lose 60 or 80 or 100% of the investment? How many times did that happen before they got one for 500? Now, don't get me wrong. You can make money buying options, but just hearing that someone made 600% return is not a reason to sign up for anything. I think we all know that. So when you're buying options, your risk is limited. In this case, it's rather small, but in percentage terms, 100%. If something goes really wrong and we're not able to manage this out or get stopped out, or mitigate our loss in some way, that's 100% loss. Keep that in mind. Margin, really not an issue here. We bought options, so we don't have to worry about what the potential loss might be. Unlike having sold options, here we just have to pay the upfront cost of $250. And our break-even points. We paid $250. That means we need to extract $250 back from the market. That can happen either on the downside or the upside. So our break-even points are what? Who knows those?
250 above 9250
Yep.
and 8250.
I'm hearing it, yes. We own a put option, so we need either the put option to be worth $250 at expiration. That will happen if it's in the money by $250, or if the stock price is at $82.50. On the upside, if that doesn't happen, then we would need the upside to bring back $250. That means our 90 call needs to be in the money by $2.50. Those define our break-evens, and then visual. You can take those numbers and draw this. In between the strike prices at expiration, we know they both expire worthless, and we lost all of our investment. We calculated our break-even points. You can plot those and connect the dots. Now we know where we make money, where we lose money, and everything in between. I'll say one thing to wrap up straddles and strangles. Who's heard or read an article, saw someone on TV say, here's this upcoming event, maybe it's earnings, and the options market is predicting an 8% move? I mean, who's heard that kind of thing? The options market is saying, quite a few of you, the options market is predicting a 10% move. Now, where does that come from? You might say, where do they get that? There's actually a few ways I'll describe where that might come from. The simple way is first to just look at the straddle itself. And I've heard some traders who say they do that. The stock's at 100, and you have a binary event. I'm going to clarify, a binary event upcoming. And you look at the expiration date right after that. Maybe earnings is on Wednesday, and you're looking at the Friday expiration right after. And you have the 100 strike, stock at 100, and the straddle is trading for $5. If you buy that straddle, you need a $5 move either way to break even, and then you start making money. So you could just simply say, okay, that is forecasting a 5% move in the stock. Investors or traders, market makers, and professionals are requiring $5 for that straddle to break even. So you could just simply do that calculation. There's another one that adds a piece to it. There's an, I don't want to say assumption, but there's a fairly widespread belief that straddles are priced a bit more or a bit higher than the market actually expects the stock to move. And that's because sellers want to get paid a little more for the risk they're taking on. If they're going to take on obligations on both sides or taking on risk, they want just a little more. So they're going to raise their prices a bit. And so another method of calculating this expected move would be to take the straddle, the 100 straddle, and then add the nearest strangle. So say the 105.95 strangle. Add all of that together and divide by 2. And if you do that, now you're sort of mitigating the straddle price a little bit. You're bringing it down slightly to account for if you believe the market overprices straddles just a little bit to compensate sellers. So next time you hear that on TV, because it does come up a lot. Prior to earnings, this particular stock might, the options market is predicting the stock might move 8% or 10%. Now you kind of know where that comes from. That comes from straddle and strangle prices. So now we know what both of those are. Short straddle, long strangle. We walked through both of those. The iron butterfly puts those two together. So we'll look at the P&L graph here and talk about what ifs, and then compare that to the iron condor. They're very similar in nature. Here we have the short straddle selling an at-the-money call and an at-the-money put. We add to that buying a long strangle on the outsides. Remember back to the short straddle conversation, unlimited risk, highest level of options trading approval, margin requirements. Some of you may have heard those things and think, I'm never going to do that trade. Well, it's important to understand the trade. As I mentioned earlier today, your toolbox. Put things in your toolbox that you might use and then use them when appropriate. The short straddle might not be a trade you use, but understanding it within the context of the iron butterfly is important. The short straddle combined with the long strangle, knowing what both of those are about, and then combining those into this trade. You can think of this as the two verticals. This is how we put together the iron condor, bear call spread and bull put spread. Here we're looking at it as a straddle and a strangle, and looking for range-bound markets. Our objective here is for everything to expire worthless, but we'll see in a second with the iron butterfly, one of the differences from the iron condor is it's very unlikely that they will all expire worthless.
Wait, can I just ask you one
Question, yes?
on that other path? Why does it say both credit spreads if you're buying the long strangle is really a debit spread?
Okay, the question is about the bullet that identifies both credit spreads, and I'll just elaborate. That bullet there is identifying an alternative way of looking at this strategy as vertical spreads, selling a call spread and selling a put spread. We're looking at it as selling a straddle and buying a strangle. Another way to look at this would be selling a call spread and selling a put spread. It's the same thing. If you look at it that latter way, it would be two credit vertical spreads. Does that make sense? Sort of.
Not when you look at where it says buy and buy.
Right. Well, yeah, right. So it's looking at this overall strategy as two different. Look at the overall strategy as the composition of two different spreads than we walked through. An alternative way of viewing it. So overall, it's a net credit. Got it. Yes. Overall, it's a credit. And here we are. So 150 is our net credit selling the Straddle and buying the Strangle. We sold the Straddle for $4. We don't want all of that risk associated with it. Now you can choose whatever strike price is. We walked through a bit about strike price selection earlier. Choosing the long strikes is about managing your risk. How wide do you want to go? The wider you go in strikes, the more premium you're going to receive, greater potential reward. Wider strikes also equates to greater risk, higher reward. Makes sense. Here we're keeping things very tight and very under control and selling the entire spread for $1.50. It's a credit spread. We can't make any more than that. So $1.50 is maximum gain and maximum risk is $1. We're only $2.50 up and down from the strike price here, so the most either side of this spread could be worth. The most we would have to give back to the market would be the distance between the strikes, $2.50. Are you with me on that? 87.5, 19.85. So on either direction, we're $2.50 wide. So worst case scenario, we give back $2.50. We received $1.50 up front, so maximum risk is $1. Now that's controlled, that's defined, and that's calculated. So I would start with your margin requirement likely being right there. It might be a little higher. As I said, brokerage firms, especially when it comes to selling options, might tack on a little bit extra for security for themselves. Brokerage firms want to let you trade. They want to let you do what you want, but they also want to protect themselves. If you're selling options, they may add a little bit to that, but we'll start with the margin being 100. Break-even points, we received 150. So at what levels might we have to give back 150? On the upside, that would be if the 87.5 strike is in the money by $1.50. That'll happen with the stock at 89. And on the downside, it's if the stock, if the puts are in the money by $1.50. $1.50 below 87.5 is 86. And there you have the break-even points. All good? So far. P&L graph, and here's where we get into what ifs. So at the top, remember what we have, a net credit on the overall strategy of $1.50. Max profit achieved when shares finish at the strike. Now that's to the penny. What's the likelihood of the stock trading at 87.5 at expiration? Virtually none. With the Condor, you had a chance. You had a gap. You had a range. Here, there's no range. So more premium received, but you're trying now to pin the stock to your short strike price. And again, generally speaking, let's just talk selling options. You want the stock to move to your short strikes. That's where you kind of want the options to settle, right near your short strike prices. Now on the trading floor, that's the same way we managed it as professionals. We wanted to be short at the money strikes to capture time decay. We wanted that working in our favor. We didn't want to be long those strikes because then we would be feeling the pain of time decay. So here, we're selling at the money, 87.5, and we want the stock to stay right there. What if it doesn't? On the downside, this is where I will elaborate, the downside looking different from the upside. Under 85, the full put spread is in the money. We're now in a position of giving back $2.50 and realizing our maximum loss of $1. If we're in between 87.5 and 85, then we're subject to assignment, which would put us long shares of stock. As I said earlier, you might be perfectly comfortable with that. With the stock at 86 or 85.5, 87, you might not feel the need to manage that because it'll leave you with long shares, and you can change that into a new position, selling options around it, maybe buying protection. The one thing I'll say when it comes to the position after you've managed or after expiration is be honest and true to yourself that the resulting position is still consistent with your market outlook. The hardest trade to make for everybody is closing out a losing trade. I know this. I had to learn it. I broke my hand once or twice. Letting a trade run, moving stop losses, letting something go, seeing a red number and not wanting to get out. You have to learn the hard way. Discipline yourself somehow to say, I am not letting it get worse than this. So I would caution you on allowing assignment and taking shares, or in general, allowing a position to move forward just because you don't want to take a loss. And I understand, human nature. I want to see a green number, then I'll get out. The hardest thing to do is to cut your losses and run. So pay attention to the opportunity cost. If I get out of this trade, maybe there's a better one where I can make that money back. I might lose a little bit here, but is this the place to make that money back, or is this other place better to make that money back? Keep telling yourself that and force the discipline on yourself to get out of the trade. Now that's if the stock is in between. One of the benefits of options, buying them for protection, is you sort of take that discipline away and you force it on yourself. If the stock craters to the 70s and goes into the 75, 70 range, you've already got the protection in place. So this comes with buying puts or buying any call or put option on either side as protection. It's sort of forcing that exit discipline on you, which I completely understand is the hardest thing to force yourself to do, taking that losing trade. On the upside, it is a slightly different analysis. Well, if the stock is through our strikes, we're in a similar position. The spread is worth its full value of $2.50. We received $1.50 for it, so we're giving back a net dollar loss. But if we're in between strikes here, you're likely not in a position to say, well, I'm just going to try and let this thing run. Because now if you're assigned, you're short shares of stock. Very different from the obligation to buy shares. So in this case, position management is undoubtedly required. What are you going to do? And of course, a lot of you said you traded options, so I'm sure you're familiar with just buying to close or exiting. And that is frequently what happens rather than taking positions. It might be an interesting fact for you to know that consistently, year to year, OCC data shows that about 3/4 of all options that are opened never make it till expiration. They're closed before they get there. It's actually one of the myths that comes up a lot. And I still get questions from people that say, well, why would I ever buy an option if 80% of them expire worthless? And that myth still floats out there, and it's completely wrong. 3/4 of options never even make it till expiration. Of those that reach expiration, the vast majority expire worthless. And that makes sense. If you own something that has no value, you can't sell it, and it just drifts itself through expiration and goes away. If it has value, you're going to sell it and close it before getting there. So it's perfectly logical. 3/4 are closed and never see expiration. Of the remaining that get to expiration, some are exercised and most are worthless. The myth ignores all the closes and just says, of all the options that make it to expiration, 70, 80% expire worthless. And this myth gets spread out there, but it's not true. So putting that in the context of our trade, if we are in between 87.5 and 90, we might want to position manage and buy back the short call option to get out of the trade. Now, who's familiar with auto execution on exercise by exception? I do want to mention that as well. We're short 2 options here. You have to be familiar with what happens at expiration. I do hear from people, and this is for anyone who might be beginners, that when an option expires out of the money, they feel very comfortable that they won't be assigned. And even if it's a penny or two or a nickel out of the money, I've heard from investors say, I'm tracking this. I saw it trade at the closing bell on expiration day. It was a nickel out of the money. It was a dime out of the money. And I got assigned. That's a mistake. That's an error. I need my money back. An option holder can exercise whenever they want, for whatever reason they want, even if it's illogical, regardless of the moneyness status, moneyness being in the money or out of the money. It doesn't matter. An option holder can do what they want with it. If the holder of an option does not communicate anything to their brokerage firm at all, the industry has to have some kind of default process. What do we do with these options? The holder didn't tell us anything. Well, since most in-the-money options are exercised, the default process from back office is to exercise in-the-money options and abandon out-of-the-money options. That's the default exercise. Some investors think that's automatic. That's the way it is, and that's not true. An investor can say, I know this option is slightly out of the money, but I want to exercise it anyway. They have every right to do so. And this does happen. You can see after hours activity can sometimes move the market. Even Friday after hours can move the market a little bit. And if you're a penny or two or a nickel or a dime, depending on the underlying you're trading, you could get assigned on an option that expired officially out of the money. Doesn't happen often. my entire career it's happened. I can count on one hand, but still be aware of that's how it works. What if something dramatic or extraordinary happened from a macroeconomic or a political or military event on Friday right after the closing bell? Something awful happened. People would be calling up their broker saying, I know my put option is out of the money. I want to exercise it anyway. Question?
What do option holders have, about a half hour after the close to exercise on a Friday?
Question is about the timing of the option holders being able to exercise. Great question. Comes up all the time. So there's a few things that are in play, but for the retail audience, what's important is each brokerage firm has their own cutoff time. I would expect it to be about 60 minutes or so after the closing bell. But each firm is going to have defined communication lines that spell out how long do you have to communicate to us what your intentions are. So you would want to find that out from your firm. How long do I have? And if I do want to notify you of a contra exercise, it's likely called something like a contra exercise notice or something like this. I'm going to do something different than the automatic procedure, then you would want to know, how do I do this? It's important to know that, certainly from an option holder's perspective, because you may be in that position someday where you want to exercise something that is not going to be exercised on your behalf. It's important to understand it if you're selling options. Because let's say you really don't want to be assigned on these 87 half call options, and the stock's trading at 87.40 on Friday afternoon. What do you do? Do you watch? Do you think, oh, I'm just going to wait till the closing bell? It's trading 87.42, 87.44. I'm good. It closes at 87.46, and you go away for the weekend, and all of a sudden something happened after hours, and it drifted up 20 cents. And is it worth, if you're comfortable with assignment, you can do that and try to let every penny go and get every penny out of your option if you're comfortable with assignment. But if you don't want to be assigned, and it's not your intention to have assignment followed by a share position, you got to buy the option back. The only way to avoid the assignment obligation is to buy the option back. You can't do anything else. So that becomes the tricky part of managing a short position. When do you do that? No one wants to pay a dime or a nickel if they don't have to. And you might pay a dime, and then all of a sudden the stock runs lower, and you're like, well, I just gave away a dime. But you know what? You manage your risk. You manage your risk appropriately. If you let things go over and over again, it might backfire. Yes, sir?
To close that position, you're going to pay a commission. If it expires, there is no commission?
Question is about commissions when you're buying back. And you may get better answers from your colleagues here. Brokerage firms are different. So the question is about, will I pay commission to close something out for a nickel? Well, I can't really say. I'm already hearing people start to rattle off brokerage names, which I can't do, but check with your brokerage firm. What is my commission if I close an option for a nickel or a dime? How does that work? So good question. And there's another one?
Yeah, to that point, is there any downside or unseen risk in setting limits to manage risk, closing as you might advocate?
So I think the question is about setting stop limits to get out. And are you referring to buying back the option for a cheap price?
In any of these legs,
Yes.
is there any gotchas to setting limits if you're trying to manage your risk as you might advocate?
Yeah, so the question is about exiting the trades again and using limit orders. Wouldn't say there's gotchas or problems. What I would say is, well, a couple of things. If you're trying to close out a short position, there should be no limitations whatsoever. And if you think, well, when the option gets down to a certain level, when it gets so cheap, I just want out. It's not worth holding an open short if the option is only worth a dime or a nickel. So you can go ahead and use limit orders there to get out. That wouldn't be a stop limit. That would be a limit order if the price got all the way down to those levels. Now, the other area I was going to mention may not apply, but it's worth just mentioning anyway. In general, if you have a position on with long and short, it's highly likely that you won't be able to close out the long without closing out the short. Now, I can't say that for sure. It depends on the position itself. But quick story on that, going back to my days as a futures broker. I had some clients that were highly, highly leveraged, long gold futures when the market was going really well in gold. And they were long the underlying futures and short call options against it. And if anyone remembers that time frame when gold massively corrected, I had clients who were highly, highly leveraged with long deltas in gold, getting absolutely hammered, tens of thousands of dollars every 10 seconds. And they were desperately trying to get out of their gold futures because they were just getting destroyed and their accounts were heading towards negative. But they were getting rejected orders. And they're panicking and fuming and calling me, I mean, through the phone. I mean, the guys felt like they wanted to jump on a plane and strangle me. That's how angry they were, because they were trying to get out of a losing position. They're like, Ed, why can't I get out of this losing position? What's going on? Well, if you sell your futures, you're left with exposed calls. I don't care if they're only worth a penny. You can't have that risk profile. So be careful when you're exiting and entering, specifically exiting, what you have and what's left over. In the case I just described to you, they couldn't sell their futures without buying back the calls simultaneously or buying back them first. Then they could have sold their futures because the risk matches up. If you just sold the futures and you have all these naked calls, they weren't approved for that. And when you panic in a market condition that is throwing you off and your account is getting obliterated, you need to have this ingrained. You have to feel it and understand it so you know what you're left with. In your context, and maybe with this spread, that's not going to apply. I just gave a little more color to it. You're more likely here to set limit orders automatically to exit when those short options reach a low level. And it's a good idea. Close them out when they're very low. And you can set limit orders and leave them in there to do that. So our what ifs up and down. I think we've got a pretty good handle on what we do at various levels. Now let's compare the two trades, the butterfly versus the condor. And I do have to put a disclaimer on this comparison that strike selection could matter here. This is not exactly apples to apples. You could go wider on strike prices and change this just a bit, but in general terms, since these trades are so closely related to each other, it's worth looking at a traditional construction of each of them and then evaluating what the differences are. And we'll put this up on a nice clean graph on the next slide, but you can see visually here with the iron butterfly, greater potential reward and a lower risk. Those are the good things. Those are the positives. The potential to earn all of that maximum gain is rather low. We discussed that. The stock would have to settle exactly at your strike price in order to achieve that. But still, higher potential reward and a lower potential loss. For those benefits in comparison, what do we give up? It's the break-even points. It's the likelihood of success, the probability of this trade being profitable. You can see with the butterfly, the break-even points are rather tight. So now if you're trying to apply this and you say, well, when would I use this one versus that one? The answer usually always comes down to market forecast and market analytics. If you are much more confident in your neutral around 87.5 opinion, and you think it's a sticking point and the market is consolidating at this level and it's going to continue to do that, you might lean a little bit more towards the butterfly because you have more confidence in that level. Using the iron condor gives you less premium up front, but look at how wide your range of profitability goes. You now have 85 to 90 before you start giving back anything. And then outside those strike prices before you reach your break-even points. So the risk profile of the iron condor looks different than the iron butterfly, but there's a good reason for that. Your probability of success on the condor is greater than that of the iron butterfly. Now there's also variations I want to elaborate. I mentioned skew earlier and how those downside strike prices trade at much higher implied volatility levels. With both of these trades, and we'll just stick with the iron condor, of the four sides, we have 80, 85, 90, 95. Which one has the highest implied volatility level? I think I'm hearing different answers. So the skew from strike price to strike price tends to be higher at the lower strikes. So 80, 85, 90, 95, the highest implied volatility level I would expect to be at the 80 level. And we bought that option. That's the long option. So of the four, the one option that has the highest implied volatility level we bought, we paid for that. If you are volatility conscious, you might not be comfortable with that. We wanted the protection, that's why we bought it. That puts the iron condor together. If you're not comfortable paying a high implied volatility level for those low strikes, and you're comfortable treating the downside as a cash secured put and maybe owning shares there, a variation of this could be to not buy that downside put and have three sides instead of four. Sell a 90-95 call spread and sell an 85 put option. Now you've changed things a bit. You'll have a higher net credit because you didn't buy an option down beneath. You don't have any protection down there. You'd have to be comfortable with that. If the stock drops, you now own shares, or you have to manage your way out of the position. But you avoided paying high volatility levels for that low strike, and you got a higher net premium, net credit. Another thing is just wider strikes. You can have wider strikes on one side than the other. Maybe you are not concerned about the upside in this particular stock. So instead of doing 80, 85, 90, 95, I'm going to do the 105s instead of the 95s. I don't really need the protection that close. I don't want it to be exposed. I can't have a naked uncovered call, but I really don't care about the upside, so I'm going to go way up, have quite a bit of risk up there, but buy a cheap option. That'll increase the net premium amount. So you can break the iron condor. You can do the same thing with the fly. Break your strikes, or as I suggested, do 3 sides instead of 4. So different things you can do there. And as mentioned with one of the previous questions, you can leg into this. Stock hits a support level, I'm going to sell the put spread. Stock rallies and gets to a resistance level, I'm selling the call spread. And then at that point, maybe you buy the put spread back, or maybe you leave it all on. Again, you have to really consider your market outlook. And as I say all that, it reminds me, commissions are going to play a role. You're doing two legs at a time, back and forth, back and forth. Commissions will certainly play a role. And this outlines what I just had gone through. The potential profit, generally speaking, on the butterfly is a bit higher than it is on the condor. The loss potential is also a bit more controlled and lower for the iron butterfly. Implied volatility exposure is going to be the same. Volatility goes up. If implied vol levels rise, that is going to work against this position. If implied volatility levels decrease, that works in our favor. However, as mentioned before, if implied volatility levels decrease, we still need the stock price movement to not work against us to a greater extent. It's that balancing between Greek exposures that needs to work out into your favor. I'll put all these up to wrap up a comparison of the two. The short straddle requires you to be accurate. There is a tremendous amount of risk in the strategy, and there is a tremendous amount of risk if you're wrong. The long strangle is more controlled, but you need big moves. The timing of the move, the magnitude of the move, the direction of the move, you got to be right on those things. And that's true when you're buying options in general. You can make good returns buying options, but your market analytics and your forecast going into the trade really do need to be sound, because all of those aspects need to come through. And early assignment. If you do get early assigned, it does change things quite a bit. If you're assigned on the put side early, now you've got long stock with your options, which could look a little bit different. So there's our various things to know. Can't stress enough. The commissions aspect to this, we have 4 sides to the full construction of the trade. We walk through position management techniques of rolling, buying the spread back, selling another one, rolling the whole thing up. All the while, commissions are adding up. And I don't want to forget to leave our contact information. For those of you here live, please stick around if you want to volunteer to give a testimonial for us. We'd greatly appreciate that. And everyone else, visit our website, sign up and attend our webinars we do every month. And thank you for attending today. Really appreciate it.